Hi, I'm Terry Freeburn and this is Jeff Clark, and we're with Buy Sell Network Realty, and we've got a bit of an update for you on some financing issues that have come up starting July 1st, and Jeff has been doing some research on that with one of our financing specialists, and so I'm going to let Jeff tell you a little bit about what if you're a buyer, what you need to be aware of. So. Yeah.
Hi everybody. So as Terry was saying, there are some changes that are being made by CMHC, the Canadian Mortgage and Housing Corporation, and that's the government body that insures mortgages that have less than 20% down as a down payment. So we've put a list up here for you, and I'll just touch base on a few of the more important points, and you can also go to the CMHC website and investigate it further if you wish. So the first thing that's changing is what's called the debt service ratio. We're not going to get into super specifics about this, but basically it's looking at the amount of debt that you're carrying as a borrower when you're coming to purchase your home. So traditionally, or at least up until July the 1st, your GDS, which is your gross debt service ratio, and your total debt service ratios were 39 and 44%.
So just to explain that a little better. Yeah. So your gross debt service is what usually is the principal, interest, taxes, and a bit for heat, right. Whatever that would be per month. And your gross debt service would be adding on any debt payments or loans such as car payments or student loans on top of that. So then the bank figures out. So on a gross debt service, you were allowed to have 39% of your total gross income before taxes, and on the other one was 44 on the total debt service, correct?
Yes, yeah. So the real change now, of course, that's going to affect people is that this is no longer going to exist, and now we're going to be using hard numbers of 35 and 42% respectively. So it just means that they're going to be scrutinizing what your debt each month is when you're applying for this mortgage, much more so than they have been currently. The second thing that is a bit of a change is that if one person or a couple are applying for a mortgage today, at least one of the borrowers has to have a minimum credit rating of 680. Again, we're not going to dwell on that, but it just reinforces that, especially for the young people, that it's very important that you stay on top of what your credit score is and that you do what's necessary to get yourself to that point.
Yeah, so don't go out and apply for a car loan or something that put before you buy your house, because that any application for applying for debt or for credit can change that score, right? So
exactly.
You want to get the house out of the way first and then go buy your car.
Yeah. And there's no question that certainly with the younger people that we all strive to want to have the cars and all of the fancy things, but you really have to set what your ultimate goal is, and if that's to buy a house, then you need to definitely focus on that. The third thing that is quite a change is what we call non-traditional forms of payment. So I'll give you a quick example. If you were buying a house and you needed $20,000 down payment and you have 10, you could look at other options to make up that shortfall. You could have a personal loan, you could use a line of credit, you could borrow from family. I mean, there are numerous ways that you can generate that capital. But the thing that's changing now is if you are using a line of credit, for example, okay, you can take that extra $10,000, but you're incurring $10,000 more debt in the big picture. So where historically CMHC wouldn't have a problem with that, now they are going to, because in theory you're borrowing $10,000 from yourself, but it also means that you have to pay that extra $10,000 back. So you have more debt load each month that you're responsible to pay back now. So I've listed a few here that were traditional or non-traditional forms, like the bank's offering you a cash back when you buy the house, which is fine, except that cash back is rolled into the mortgage, so it's actually increasing your debt load.
So now they won't allow these, right?
Right.
Not to say you can't have a line of credit or anything, but they're not going to allow that to go towards your down payment.
Yeah, so they're not going to consider that money that you're borrowing from yourself basically to add to the 20% that would get you out of requiring the mortgage insurance. So, you know, Terry and I had a little discussion, and we were just looking at sort of what this means to us overall. And, you know, it's a couple of important things. And one is it's really going to force people now to certainly buy within your means. You know, we've gone through a period with extremely low interest rates. So even though house prices have been going up, people have still been able to buy houses perhaps that really may not have been the best starting point financially. But they were able to get the money, so they bought those houses. Maybe, you know, you're going to be forced to rely on family members more, because again, borrowing from your line of credit or other forms like that are incurring more debt, you may not be able to go that route now. So you may be forced again to ask the aunt and uncles, grandparents, whatever it happens to be, for basically an interest-free loan. Start smaller and work up. You know, instead of striving for that almighty big house at the beginning, you know, you may have to...
Something more affordable.
Yes, and something that, you know, and Terry and I could certainly explain that later on, but just allowing you then maybe to start that portfolio and sort of progress yourself through the real estate.
Yeah, because the interest rates right now are at really low.
Absolutely.
They're at, what's the 5-year term right now? 2.24.
For good qualified people.
Yeah, so I mean, how long are they going to stay down here? So if you had to renew your mortgage at a higher rate, you know, can you afford that higher rate?
Yeah.
You know?
And then the last thing, again, I touched on it a little bit earlier, but it's just going to be so important as we go forward to make sure that, again, you're protecting your credit score, making all your regular payments, and at least, or at the very least, understanding what your credit score is as you go forward, because you know, you could think everything's perfect and you get a big surprise.
So one thing that's come to my mind, so this is through CMHC, right? So if you go to your bank and your bank's going to approve you and then send the application off to CMHC, you know, that means you're going to be able to afford a lot less house, right? Or even get shot down on your deal.
Right.
So one of the reasons why we recommend a good mortgage broker, right? Because those mortgage brokers can go to a number of different lenders, and they will probably not send your application to CMHC. They'll send it to one of the other two mortgage insurance companies that would be a lot more lenient, right, than these type rules. Now, that could change, right? Those companies could all of a sudden change too, but this is as of July 1st when CMHC is going to come into effect.
Yes.
Now the other thing I had printed off here, Jeff, I just out of curiosity to see what the average home sale price of Peterborough. If you bought the average home in Peterborough, right, and you put 5% down on the house, your mortgage payment would be $1,795 a month, a little less than $1,800 a month. I know right now renting a house is more than that. Now that doesn't include your taxes or your heat, insurance. But if you got heat and hydro on an apartment, or if you rent a house, you're going to have heat and hydro anyways. But yeah, it doesn't include your taxes or insurance would be on top of that. But still, you're probably cheaper to buy a house still right now because the rates are so low than you are to go and rent one if you can get that 5% down.
Right, and you know, to go along with what Terry's saying about that is, you know, we've seen a drastic increase in the price of these houses in a very short period of time, and a lot of people get the mindset that, you know, they'll just never be able to afford home ownership. But you know, what Terry's discovering here is that, you know, when you're going to go out and spend $1,800 or $1,900 a month on a 2-bedroom apartment in Peterborough, you know, Terry's just figured out that with 5% down,
$2,500
right,
for a house.
You know, so in the big picture, your mortgage payment's only $1,750 with the 5% down. Now, as you said, it doesn't include your taxes and stuff, but if you can do it, guys, it's still recommended to come into the housing market if you can.
Yeah, so we thought this would be an important update on real estate that you might find interesting if you've got a family member looking to buy a house, or you know, need some help. This is something you may want to consider, right? So. Yeah, so we certainly appreciate your time today. Make sure you visit us on our website at peterboroughrealestate.forsale. We have our foreclosure website, peterboroughforeclosures.com. You're welcome to visit us there, and you can follow us on Facebook as well. Thanks again. Appreciate it.